Think back to the last time you actually had to walk inside a physical bank to manage your money. For most of us, we now split restaurant bills, secure mortgages, and invest in global markets, all while we tap our phones waiting for coffee. We are living in the era of fintech. It is exactly what it sounds like, the active blending of financial services and modern technology. Industry researchers like Friedman and Schufel define the field through the creation of entirely new systems designed to reform how we access financial services, breaking down rigid, centralized structures. The focus of this new ecosystem is entirely customer-centric. Instead of forcing you to adapt to institutional hours and geographic limitations, financial products are now tailored to individual preferences and immediate needs. For centuries, traditional banks held an absolute monopoly over global capital. You had to play by their rules. Over the last 100 years, however, technology has been quietly creeping into this ecosystem, laying the groundwork for a massive disruption. Fintech challenges the foundational banking model, shifting the control of global wealth away from institutions and toward the individual. The first phase, Fintech 1.0, ran from roughly 1866 to 1987. The introduction of the telegraph allowed financial transactions to be communicated much faster than ever before. By the 1950s, the invention of the modern credit card system allowed consumers to carry a line of credit in their pocket. These innovations, alongside electronic funds transfers and the first ATMs, certainly made banking more accessible, but they were built to serve the banks, making their existing systems operate faster. Then came Fintech 2.0, running from 1987 to 2008. This was the digital transition. Computer-based finance took over, and electronic banking services became the standard. Growing computer networks linked global markets together. This era also birthed purely digital payment systems like PayPal, moving real money through internet browsers for the first time. By the end of 2008, the technological infrastructure to digitize money was fully built. Yet traditional financial institutions still controlled the underlying infrastructure of the global economy. The 2008 financial crisis served as the ultimate catalyst. When major institutions failed, public trust in traditional banking collapsed overnight. Consumers actively searched for alternatives. This desperate need birthed Fintech 3.0, empowering tech companies to offer financial services without the baggage of a traditional bank. The industry quickly split into specific product tiers. In the white label tier, banks buy third-party technology and offer it under their own branding. The direct tier is more aggressive, bypassing traditional institutions to connect services straight to end users. There is also a gold label hybrid tier. Services like Apple Pay combine attributes of both, providing a highly competitive, branded tech solution that partners closely with existing financial infrastructure. But the ultimate manifestation of bypassing the banks arrived in 2009 with the launch of Bitcoin and the rise of cryptocurrency. Cryptocurrencies and digital e-wallets utilize blockchain technology to allow secure, anonymous, and frictionless transactions. They require absolutely zero central authority to verify who owns what. Building intensity. The 2008 crisis shifted technology from a supportive back-office tool into the primary means for the public to achieve financial independence. If you zoom out and look at the global landscape today, the impact of these technologies looks vastly different depending on regional economic needs. In the US and Europe, the market is dominated by intense tech innovations and collaborations with legacy banks. However, investment in these regions can occasionally stall due to broader political and market uncertainties, like the fallout from the Brexit vote. Shift your focus to Africa, and you see emerging tech hubs deploying solutions designed strictly for local needs. Platforms like M-Pesa in Kenya use mobile banking to bring millions of previously unbanked citizens directly into the digital economy. Rapid growth is also sweeping the Asia-Pacific region. Massive markets in China and India are relying heavily on mobile payments to drive adoption in areas where physical banks never existed. Outside of Western financial centers, fintech is solving the critical human problem of global financial exclusion. But a decentralized digital economy comes with a major catch. As transactions become frictionless, systemic vulnerabilities grow exponentially. We are seeing a massive rise in cyber risks. Hackers are continually launching aggressive attacks, targeting both the core platforms and individual consumers. Developing robust cybersecurity strategies is no longer an optional IT expense. It requires relentless, ongoing vigilance from both the companies building these tools and the users trusting them with their data. Looking to the future, the industry is already anticipating major advancements through AI analytics and broader blockchain applications. This will require deep regulatory engagement to ensure consumer protection doesn't fall behind the technology. Fintech has evolved from simple telegraph wires into a global infrastructure that prioritizes transparency and efficiency for every user.